Hey everybody, happy Thursday. Welcome back. Just at 3 o'clock, April 3rd. Not April Fool's, not Liberation Day. It's the day after. So this is a little joke. If you've seen the old headlines with markets and turmoil and how that's a contrarian indicator for CNBC, just thought I'd have a little fun. Look, cooler heads are going to prevail. This market's going to figure it out. We'll have to figure it out. If you're navigating it, it's not a run and hide. There's plenty of opportunities here. Um, I'm certainly curious to see. This is the comment that I saw from President Trump today. Trump on market reaction. It's going very well. Apparently, he didn't see what price did yesterday for one of the largest gaps we've seen in several years. The market is going to boom. My concern is that we've spent years climbing this wall of worry, and now we have a president that is kind of jawbone the market to say it's the greatest thing ever, and he's going to go back to being like the market, cheerleader like he was in 2016 when it's like, look at this market up every day at all-time highs. Very different scenario. As if now we're trying to like coax the market, like, hey, look, the reaction's in, tariffs as bad as it gets. Now it's time to go up. We'll see. I know sentiment is still really bad. I want to take a look at that today with AAII sentiment. We should have a new print from yesterday. So let's have a look at this. It's even more bearish. This printed yesterday. This is before, right? So it's just nuts. Like, again, not a signal, but some of the worst readings we've seen maybe ever or close to it. I don't know if it's actually on here. AAII sentiment. Nope. Let me see if I can find like all time. Let me see what it says here. Bearish sentiment reaches 1-year high. That's not a surprise. I'm looking to see bearish sentiment among investors hits all high, new high. Oh, that's new high. Never mind. Bearish sentiment 1 year. So all I'm seeing is 1-year high. I was looking for like all time. How bad is it really out there? But anyway, not a signal, but also contrarian wise, this usually is a play that everyone is so bearish. Let me see if I can get some put call ratios running. Let's get some put calls going. Here is, let's go sentiment put call ratio. Okay, so not quite as high as where we were March 28th when the market was bottoming. This is as of April 2nd. So I'm curious how many data points we got. April 1st, April 2nd. So I'm wondering if today it's just like an obscene amount of puts, and this put call ratio is again like climbing. I mean, these have been pretty good timing indicators. March 13th was the bottom. March 28th, surprisingly, was the March 28th was where? What do we do March 28th on SPY? March 28th would have been market sells off on a Friday, put call ratio that particular day. Okay, fine. And then we battled back for a couple of days. That was our Friday, and then Monday was the quarter end. So we had Monday, Tuesday, Wednesday to the upside, and then obviously we had the gap lower today. All right, let's get to the charts and the technicals. At the top of the hour, by the way, I am starting at 4 p.m. Eastern time. It's going to be class number 1 for my crash insurance master class. I'm running this for about 250 members. And lots to talk about. Clearly, right in the thick of things with how I'm going to position the portfolio. Calculated risk. I'm not really trying to be perfect in timing. I'm trying to give myself a window that if we have a market going down through August, through September, through the end of the year, I want to get paid on some really asymmetric hedges. So what that looks like is I'm covering, what happened with this Liberation Day, what the markets are pricing in. We also have seasonality in the markets. We've got technical indicators that I look for when it comes to ways to protect your portfolio. When I looked at time this over like a 30 to 60-day window, hedge strategies for the entire portfolio, and then also hedge strategies to protect your favorite stock position. So that's what I'm covering in the class. That is today at 4 p.m. Eastern time for members. If anybody's interested, you can still get into it. I think we maybe have it right up until class day, but then we cut it off. It's $197 to get you in for the masterclass. It's an April masterclass series. I run it today and next Thursday and next Thursday and next Thursday. Right. So lots to talk about in class. Come here. Come on. Benji wants to come say hi. Come on. Up. There we go. So there is that. I want to look at put call ratios after today. We went 3 for 3 today in daily profit play. These are some of the levels that I'm watching on SPX. So I have a broken wing butterfly that is down here to 53.40. This is likely going to finish with full profit in the next 50 minutes. This was a trade from this morning at the 55.25. Let me check my SPX right here. So this is $2 out for 150. This is 260 out for 210. This is 50 cents looking to go down all the way to zero. This was a call butterfly spread that didn't get filled. I'm going to cancel this one. It's not going to get filled by the end of the day. Yeah. Actually, I'll fudge. Actually, that was a trade that I put in for tomorrow, but I'll address that tomorrow. So, $50 here per contract, $50 here per contract, $50 here. So $150 per contract on some SPX trading today. Not too bad. I did take a butterfly spread also for my double up service. I grabbed about a 23% profit on the day. I obviously wanted to go after more, but I don't think the expiration today was going to do the trick. So I took my little winner. I took a 65-cent debit, closed it out for 80 cents. Right now, it is trading for about 70 cents. So I issued that closing alert about an hour and a half ago for members. Hopefully you're able to grab. I saw it trading up to like 95 cents. So if you went from 65 to 80, 65 to 85, 65 to 95, somewhere in there between like a 20 to 30% winner. Not bad. And then a couple of good wins on SPX for the day. Hedges, got some positions. There's still plenty of protection. Right now, my hedges are up around, let's see, about $13,000 in the futures market. I also have hedges. I mean, gold is still considered a hedge plus an asset, so I've got gold working well. I'll do the math here. So portfolio wise, hedges about 13K, plus another CEF is up another $3,000. If I go to GLD, GLD is up $17,000, and PHYS is another one that is up $3,200. Silver had a pretty rough day today, but my SLV positions are still up around $5,000. And also, I want to take a look at TLT. I might end up rolling TLT. We're up to $92. This could get called away for income at the end of the month. If we're above 92, this get called away. I think I'm going to try to roll this out and up because I'm on this TLT trade until 2027. Let me go to TLT. So this is a diagonal spread. And I'm just going to label this. This, like every account has this, so this is a good thing. Let's go back to this 65 by 92. So going diag spread. Same thing here. That'll just help me keep it organized when I look at the entire portfolio. Same thing here. All right. Hopefully the premiums are decent. We're at a 51.9 IV rank. That's good. There we go. Okay. Just a couple more labels, and we should be good to talk through this. This one. Okay, that's cash. Not bad. All right. This account, this account, this account. Diag spread. There we go. Okay. So what I'm looking at here is by the end of the month, $92, the spread gets called away. So I would have to exercise this. Right now it's trading for about $864. My max profit on this trade, if I look at let me see if I can analyze this on the graph. So right now I'm sitting in what is my max profit zone by expiration. I'm going to see if I can roll this and just roll the call side. So for the $1.25 that I collected here. Can I go out another month? What I want to try to do is roll it out in time and up in price. My goal on this is to try to get this up to like $100. I think that TLT has room to get up to $100. There could be some more consolidation ahead, but from this level here, if we break above 93, I would just measure this move, and I think we have room up to the high 90s. We have previous highs up above 101, 102. So the same trade I did last year on the diagonal spread, I took a nice chunk of profit there when we did hit this second high. So I'm looking to do the same thing if we get a breakout. Let me measure this and see where my level is. So we take this low, this high, plot some symmetry with that little pullback. That would get me up towards about 96.50. So, again, if I'm rolling out and up, I don't know if I'm going to get premium or credit for doing that. So I might just try to inch it up like $1 or $2 at a time. But let's see if I can roll this. Let's go quick roll. So I roll it out to May. Let's go out to monthly expirations. Let's go May 16th. I mean, heck, I'll just go to the end of the month. That's fine. If we go up a strike, so I can roll this up $1 and get another 28 cents. I can roll this up another $1 and have to pay for it. So let me see if I can. Let me see how far I have to go out to roll this up into like the 90, 94, 95, 96. So if it gets called away at 96, I'd be okay with that. I don't want to pay a debit for it, so I'm going to go out further in time and see how long that takes. So if I went out to June 30th, July, it's essentially a free roll if I go out to July, which isn't terrible. July 31st, go out to the end of the month. That's fine. I think this is okay. If I get it called away at 96, that's $4 more profit plus a 17-cent credit. I'm going to take this trade. So this is a roll up from 92 up to 96 out to July 31st, pulling in 14, 15, 16 cents credit. See if I can get this filled at 15 cents for another 2 contracts. So 17 is not filling. 15 is what I put in for my broker. The heck? Filled at 14 cents. Okay, so that's a roll. And that's going out to July 31st. So I'm going to update this in my tracker. So MO I need to roll. TLT I am rolling. So I'm rolling it up to 96 and out to July 31st for 14 cents credit. All right, so I'll do the math on this in just a moment. Let's go each account. So TLT, taking the 92, rolling it up to 96 and out to July. Hopefully 15 cents will fill. 15 cents filled there. Okay, good. 92. Quick roll. Up to 96. Out to July. What? 92 to 96. What the heck, man? April 30th. April 30th. Why is this not rolling different? Quick roll. Oops, out to July. There we go. Let's go 16, 17 cents now bid. 17 not filling. Let's go 16. You dirty dog. I'm just trying to get basically the slight credit on this. 15 cents got filled. All right. And again, we repeat. So looking to roll out to the end of July, up to 96 for 15 cents. Son of a biscuit. Let me go back to this trade real quick. So this SPX trade that I put in just now, I thought we'd hit 5,400. This guy right here, this is trading for probably, this might be looking good. Trading for $1.05, $1.10. That's my butterfly spread for my double up service. I told everyone in the alerts that there's a chance we go down to 5,400 today if you want to hang on to it towards the end of the day. So now it's offering a little bit more credit. I wouldn't be greedy here. Taking a 30 to 40% winner, that's still pretty darn good. We'd have to get into the butterfly spread in order to offer that potential profit trap. So if you're in a butterfly spread, this is peak profit at the end of the day. So we'd have to see price get all the way down into 54.10, 54.09, 54.08, and every trade. So 54.09 is an extra dollar, 54.08 is an extra $2, $3. Potentially, this is a $10 profit trap with what only cost me 65 cents. So not a bad trade. You can see this starting to offer up some additional credit, but I wouldn't be greedy. I'm just happy with like the 30 to 40% winner. All right, moving on. Let me go back to TLT. This account, I just did it for TLT for the roll. Moving on to the next account. TLT for this account. Here we go. Roll this out. So rolling. So if I go out to July 31st and up to 96 for 15 cents, fill the order. Come on, man. This is the bid price, dude. $0.15. All right, I'll do the math when I'm done with all these trades. So roll out to July, up to 96. July up to 96. Okay, it should be the exact same trade. Quick roll. Out to July, up to 96. There we go. Filled. July. Filled. Good. 54.10. That butterfly's looking even better. No trade there. No trade there. No trade there. And trade here. So diagonal spread. That one's already covered. So I'll organize this. So basically the way this works is I was looking at when the trade was originally constructed. So I go to one account. The trade originally was a 65 by 92. Let me update this in my tracker here. TLT. Okay, so I'm going to update this. Rolled out to July 31st. Expiration. 96. Sell call. 14 cents credit. So the net debit goes from 21.17 to 21.03. And the break-even price is now 21.03 plus 65. 86.03 is my break-even price. Okay, so the way this math works is if I get it called away at $96, I make $9.97 per contract. And I have right now on TLT, let me count up my sell side. If it gets called away, and I'm going for TLT to get to like $100. I think that's a pretty fair assessment. Now I have 96, 4, 8, 10, 16, 20, 2, 30. I've got 30 contracts. So 997 times. So I got 30 grand on TLT if it gets called away at $96 by July. That's a pretty good income trade. That's a pretty good hedge. I'm happy to do that because I do think that right now the pressure's on the Fed. I saw that on the calendar, it looks like we have 3 to 4 cuts that the futures market is looking to price in for the Fed. That is right here. Let me see if this refreshed at all today. But now it looks like it's still going to be June, possibly July, and then again in like September, and maybe one more by the end of the year. So here's the probability for uh, May is still likely to be a pause. June, one cut. July, another cut. September, another cut. And December, another cut. December is a slim majority here, but if we have potentially 3 to 4 cuts, that's a lot different than one or two. So the Fed just got a little bit more dovish, and maybe it's pushed out to the second half of the year, and we'll see what that looks like. But that should ultimately bring yields lower as long as inflation data continues to be trending the right direction. Which, based on what I see for trueflation, should be. I know that's the argument. Tariffs more inflationary. It's not going to help. But look, oil prices have dropped a ton, right? Oil's down a ton today. I mean, oil's down like 6%. Gold is still sticky. Dollar index has got absolute cream today. But there's a lot of like scrambling to kind of create this efficiency. Market doesn't usually have like these giant one-sided moves that have in some type of balance. But pretty wild day. I don't know the last time we had a 4+. I mean, S&P's down 4.5%, Nasdaq down over 5%. Might be one of the worst single days we've had percentage-wise since 2022, maybe since COVID. Obviously, the headlines will tell us in probably the next couple of hours, but not a great day. Small caps down 6%, and we're in some open space. I almost put a trade on this morning on IWM, but I thought, why would I call the bottom here? If it just falls naturally to it, I'll just stay out of the way for a bigger move. But I said my biggest concern with IWM is that the market from this high and this low, this is a center low. To me, this is a high and another high that would form potentially a double top. There's no reason for this market to have to stop right there. It certainly could, but if we go in a true double top, you'd have resistance here, a center low, and if this breaks the lows, we're going back down to freaking COVID lows on IWM, if that's the case. So I'm looking at this as, unless we do something miraculous here off these lows, I would be selling rallies on IWM or just waiting to see if this is a level to take a defined risk trade. But not picking the bottom is probably the best thing right now. DXY, big drop. Oil, like I said, down 5+%. USO, big gap to the downside. UNG, did that take a hit? Not really. Natural gas is still up there. I've got a diagonal spread. Gold, very indecisive. I keep waiting for gold to give us some type of sign of a pullback. Indecision is one thing. This might be a bit of a topping pattern as we get into Q2. There could be some interesting pivots now that Q1 is done. There is a market seasonality that I'm sure everyone is kind of interested in. This is usually what the market does. I mean, for 70 plus years. Christian, what's that trade you're talking about? Sold that butterfly for 95 cents. That's good, man. 40 cents on the dollar. That's good. Fees are always very high. Where are you at? I mean, my fees are like, I don't know, $3 total to get in, get out between the the CBOE feed and 60 cents a contract for my entry. It's like a couple of bucks for a contract. So are you in the US? Who's your broker? I mean, anyway. Okay, so March. This is kind of nuts. Like, this is 70 years of S&P. Usually the market starts off like Q1 is not arguably bullish. And by the time we get into March and April, it's usually called the Ides of March, which is the second half of March. The market starts to get some traction. This is always the pre-summer push that I talk about. This is what I like to position for. The market has not seen it in 2025. And, realistically, I think that the market might still be based in some seasonality where we can maybe this tariff news was truly like the market's way of overreacting to the actual news event, but in fact kind of pricing in whatever lows it is, and then the next shoe to drop would be earnings. And that could be this area, right? Like, we might still have a little bit of recovery. It's not going to be an all-time high in my opinion, but I think a little recovery, a little stability would probably be fine. But I don't know if this goes higher with another like July, August, September pullback. Because if you flip this, it's like, okay, we just had a sell off through February, March. We pulled back for 2 weeks. We flushed all the way back down. We poked the lows. We came up for a couple days. We're now gapping down here again. Now, if this market is trying to do something very tricky, like a falling wedge, maybe it just grinds out this and the market does in fact find a way to build something to the upside in the near term. But all-time highs, I think, are a long ways away. I think this is probably the toughest road ahead for the bulls right now. And if we do have a pullback, I would still think that resistance to that resistance is an opportunity to sell again for another leg lower. Okay. So I'm pretty skeptical of any real bullish rally outside of a correction that just keeps the market stabilized, but just doesn't let the absolute floor drop every single day. But we're getting we're getting a complete contrarian view of seasonality. Like, this is not doing anything for the month of April. April, May, June, July, arguably some of the biggest bullish headwinds that the market has, or in fact tailwinds rather. And then you have more of your pause and pullbacks coming August, September, and then usually Q4 is pretty good too. But not looking great right now. Gold, silver's down way, way, way lower today. Silver's down over 6%. We'll see. I am wondering on my. I don't know. I'm not doing anything other than holding right now, but I think I just had about 12 grand in silver go away. I was up about 17K in silver. Now it's down to 5K. So I've had about $12,000 in open P&L go away, which, all right, I got to check this butterfly now towards the end of the day, just for fun. Now it's trading for $1.55. Holy shnikes. And there you go. I mean, it's 3:32. You still got a half hour left if you want to ride this thing out, but it's already up 100+%. So if you close it now at $1.60, $1.60 divided by or minus 65 over 65, I mean, you're up 146% if you're riding this thing out. Then this is it. Like, this is the gamma level of 5,400 that I talked about. We're pushing down there towards the end of the day. Like I said, don't be greedy. It's already up 120, 130%. If you're still managing this trade, take the profit. It's good. Is the market transitory or stagflation? Stagflation only comes with job losses. Like, put that on a sticky note, put it on your computer. Job losses are going to be the way that this market tips over into recession. So initial jobless claims, okay? This data point right here that looks like it hasn't moved in a decade, this is actually through COVID. This is the chart that I'd be watching to see if we are going into a recession. This is how we have a recession. This is how we have stagflation. Everything would have to point to a weaker, crappier labor market. It's that simple. So unless this starts to spike higher, there's no stagflation and there's no job losses, right? And there's no recession. That is the one thing that the U.S. economy is clinging to right now, is that people have jobs and are keeping jobs. If anybody wants a job, they're available. But if this starts I mean, look, you can zoom in on this and see that, okay, let's ignore kind of COVID for a second since it spiked up. But the trend, in my opinion, would be right here. If we break higher than that trend line, then I would be concerned that our initial jobless claims and continuing jobless claims would start to trend higher. This would not be a good sign for the U.S. economy, because the last thing would be, okay, we've got tariffs causing a trade war, causing uncertainty, causing havoc. Okay, fine. Next, you have earnings. If earnings are worse, if earnings are cited with all the transcripts and all the phone calls and everything is talking earnings, right? If it's all the hell, I'll check that in just a second. If we have, why does it say sell? If we have earnings that are painting a lower guidance forward, the market still hasn't priced that in yet. If earnings go down and companies look worse for wear, and all of a sudden you see a dip in the stock market, maybe translates into people that are getting hurt in their 401ks, getting hurt in their investment accounts, getting hurt in just overall sentiment. The consumer backs up for a second, stops spending as much, consumption goes down, our economy stalls and slows. Like, see what I'm saying? Like, it's not going to happen all at once. But if we start to see the next the next piece is earnings revising lower. I've said this for like 2 weeks now. If the earnings revised lower are severe, the market isn't priced into these lows yet, right? But it's earnings to then the consumer. So if earnings and then job losses, consumer, put that in kind of one batch for like citizens, right? Um, that's where I think this market is going to have to wait and see. I mean, the Fed cutting rates doesn't change anything. The Fed's going to cut rates. They plan on cutting 1 or 2 times. Now it's 3 or 4 times. If the market's dropping 20%, who gives a crap if the Fed's cutting rates? It's not going to help the stock market, right? And if the Fed gets too aggressive too quickly and the market doesn't bounce or buoy from that, it's not going to help either. So, look, the Fed has cut rates when the market's dropped 20+%. An average peak to trough correction can be up to 20 to 30%. I know that's a big difference between what's a 20% pullback versus 30%, but how reflexive is the market? How nasty does that bottom get? I have no idea. I don't think it's going to be a straight line, but still, um, until this is trending higher, this whole idea of stagflation, it doesn't exist in my vocabulary with fundamental data. I'm watching it, but until this actually breaks and starts to trend higher, that would be my concern. And look, the market might already be down as this is trending higher. The market might be down way before this starts to show the data of, hey, look, job losses are coming in more, jobless claims are elevated, and they're trending higher. Maybe, right? But I mean, all these things that have been lingering, you have to remember this market for years have caused the wall of worry to be climbed because everyone thought a recession. Everyone thought a recession, right? And it didn't happen in 2022 despite the bear market. It didn't happen in 2023. It didn't happen in 2024. We're being told right now it's fundamentally like we're still strong, the economy's strong, the consumer's strong, resilient, blah, 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 for now. But what I don't like is how this narrative has switched from the wall of worry where everyone's worried about this downside and everyone's worried about this recession to now the president saying the economy's going to boom. The markets are going to boom. I think that's bullshit. I really do. You can't jawbone this market with so many legitimate concerns that have been brewing for years and now say that, look, my tariff stuff is done. It's out there. The world can figure it out and price it in. The markets are, is it going to boom? Maybe it booms from a 15 to 20% dip. Maybe it booms from a 20 to 30% dip, right? Maybe over the next 3 years, the market does get to all-time highs, but not without pain that nobody really has coming right now, or that certainly hasn't been priced in. So just saying, it's not panic. It's trade your way through it, but I definitely want to have risk protection. I definitely want to have, hedge trades on. And I don't know why you shouldn't do that. I mean, this is literally the class I'm doing in the next 20 minutes because I think I'd be doing, my money and my client's money a disservice if I didn't have some type of protection, right? So what trades are running for me that are doing really well? ES is a hedge, MES is a hedge, SPY is a hedge. And then of course I have, GLD is fine as a, kind of non-correlated asset. Silver is fine. I'll trade futures on those as well if I like them. And then TLT is my hedge. I also have FXY, which is Japanese yen, if we're starting to see a de-risk event in the currency market that's not giving the dollar any risk off flows. It'd be favoring the Swiss, it'd be favoring the Japanese yen. So I'm basically, short S&P futures. I'm short the SPY. I'm also trading a hedge on XSP. So 1, 2, 3, 4. I'm trying to think what this total exposure is. Maybe 1/4% for each asset here. So 1, 2, 3, 4, 5, 6. I've roughly got 1.5 to 2% exposed, right? 1.5 to 2% exposed to potentially offer 10% protection. So even if the market does drop 20%, I can eliminate a lot of that drawdown. If the market drops 25 or 30%, hopefully I can eliminate half of that drawdown, and just keep trading my way through it. But this is what I'm using right now for hedge positions, kind of non-correlated positions. And I don't think the market is full on pricing in a recession. It's clearly not pricing in a recession right now. The market essentially overreacted yesterday to a tariff announcement that was brewing for the last couple of months. We knew it was coming, and now the market took it very seriously because it was a abrupt about face, right? Like this market shifted so hard yesterday. Literally the futures market, I put this in Telegram. This is my trade. This is what I looked at yesterday. So, we went up here when I saw the first announcement. I was doing a live webinar yesterday, and I saw the 10% tariffs, and I'm like, well, that seems a little bit lighter than everyone thought. It was 20% across the board, 25% across the board. So 10% seems reasonable. And literally 15 minutes later, it's like, blech, just puke. And that entire rally for the day just was gone. And then momentum, market closes from 5 to 6, opens back up, goes lower. It did end up pulling back a little bit. Did end up pulling back to around this 30% zone, and it's back to the lows today. So here is the current look at futures. If I go to ES right here, this is the day. So that's the same fib that I drew yesterday, and we did pull back right around that 30% handle. We didn't stop at today's lows, right? We got a little choppy off the lows, but we didn't stop at them. So I mean, does this continue to slide? Sure. There's not a lot of support in this market below 5,500. If you're looking at the S&P 500, I'll go back to SPX here. We're at 5407. I've got a broken wing butterfly pin at 5340, which should be fine. This is in 20 minutes. I'm pretty sure I'm going to pull 50 cents out of that today. If it wants to come lower, that's a profit trap. If you're in my butterfly spread for double up, you're getting, I don't know, maybe $1 or $2 extra of profit there if you want to close it out. I like I said, don't be greedy. But on the S&P, with this low, I mean, this candle for the day is one thing, but for the week or the month, I mean, the month is not over. Okay. The month is not over. But we are not off to a great start. Like March is a terrible way to finish the quarter, bring us down for year to date red, and then April is just continue where it left off. So this isn't a typical seasonality play. This is the market potentially pricing in things that are not so great. A correction that is a little bit more severe than just a typical buy the 3% dip and 5% dip and get paid at all-time highs. This market might be putting in the highs for the year that don't really get hit anytime soon. So I'm just saying, I don't think it moves in a straight line, but coming down and rallying up to me is another opportunity to be selling unless something changes. This narrative has to change. Right now, it's too pessimistic, which I know as a contrarian could be like, oh, this is such a good buying opportunity. But the reality is, I don't think the market is priced in lows. I don't. I don't think that just a little tariff scare is not enough to change the entire narrative of valuations, right? If we start to see scared companies on their earnings announcements saying that they're uncertain about the future, that tariffs have disrupted business decisions, if companies start scaling back and pulling back and not spending, not growing, and they're just trying to hang tight in this uncertain environment, that's going to get revised lower. You're going to see earnings look way worse. And that's, I don't know, April, May, like these next couple months, if earnings don't look stellar and impeccable, and I don't know if MAGS is going to save the market either, right? We're down to fresh lows in MAGS right now. Here's the daily time frame. Okay. MAGS was up, and I thought, okay, well, maybe this is a bit of a bullish divergence trade, and then boom, freaking gaps lower. MAGS is down another 7%. So that closed yesterday to that level today. It's like we didn't do anything on MAGS today. We really didn't. In fact, I should probably look and see, maybe I should get in. What kind of options do I have here? Weekly options. Are the premiums good, bad? They're not great. That sucks. I mean, the stock is only $44, but let me see what like a 30-day covered call is. I mean, the premiums are awful. So it's not something I can really trade options on. I mean, if it was like juicy options, I'd be looking to maybe sell some premium on it, but I just don't like it. So this is the symmetry that I looked at. Here is a high to low. If we're lucky, and this is again, I keep saying this for the bulls. If we're lucky, the bulls try to fight back and stabilize this market a little bit, but I think the bears come right back in. And between this trend line, this trend line, this trend line, this trend line, the bears are going to be waiting to sell more. So either this is going to be the dump of all dumps to keep falling and make everyone really upset and really scared, or the market does stabilize. We fill the gap, we pull back a little bit, and then it's fine. But it's still a bear flag in the waiting, right? If this is a bear flag in waiting, even with that little poke, it's like I still wouldn't put a ton of emphasis on this market going too high. So MAGS is going to be a big deal to how the market is going to move, because if this keeps sliding lower, that rotation is so crucial to the market's health. I mean, everyone wanted to run out of Mag 7, and they did, and the market dropped, and we saw Mag 7 drop 20+%, and we saw the indexes go with it. But now that it is down 20+%, I don't see anybody jumping right back in and saying, "Hey, let's buy mags at 25% discounts." I mean, this is a stock that could be down. This is a representing like an ETF that represents the stocks that could be down. I mean, why not 50%? Why not? Take this low to high and take it back 50% and then see if that's a spot where maybe we can start repositioning at good valuations on these stocks that do make a lot of money, but fundamentally they are big enough that if the market doesn't like them and needs this rotation away from growth and momentum, that it's going elsewhere. So before I go, I did want to look at a couple of different plays on MO. I have some shares of MO. I'm looking at some fresh positions. I think this stock can also fundamentally go a lot stronger, a lot higher. We do have some overbought conditions on the weekly time frame, which makes me a little reluctant to buy new shares. I'm going to see if I push this out. I'm looking at I've got a 52.50 and a $55 covered call right now. That's, I'm not collecting the dividends on those, which I want to, since this is like a 7% dividend stock. But I'm up, like 2,000 shares from the price point of $39. So I've got a lot of profit here that I'm trying to protect. I wouldn't mind just having the income to continue to roll in like every probably 2-3 months on the premium I get on the stock. Like I said, fundamentally, I mean, I'd love to see the stock if I can hold on to it long enough. Maybe we get back into the 70s again. But we are sitting with some overbought conditions. I could see this market chopping a little bit. But I'm curious if I just, sell a call, buy a put, hold it longer. If I get the dividend, great. If it goes down, I have downside protection. If it, goes up higher and appreciates, I'll get my percentage all the way around 10, 11% plus the dividends. Could be bad. I'd like to rebuy it again in like the 50s if it's going to offer that price. Otherwise, 40s. But I think this is also a good rotation away from everything that is growth, everything that's momentum. This is a negative -0.1 beta, which means it is not correlated at all to the S&P. It's good. I think that's a great protective stock to go into. Dipsy, I'm going to see that companies have promised to. So what? I mean, is it happening? Is it happening? Government firings will increase, not until September, though. A lot of the severances are paid out through September, so that data won't pop up until later this year, which is also why I can't get super bullish on the markets. Yep. So September is when it starts to pop up as unemployed if they're not going into the private sector. I just had a thought on tariffs. If Mexico assembles American-made cars, what the tariff situation for Mexico? I don't know, Lee. Honestly, like I'm not going to dive into the granular details of the tariff stuff because I understand it's like a bargaining chip, but I feel like the U.S. just tossed away a lot of exceptionalism, and the leverage that we had on the world has just leveled the playing field with this announcement. This trade war has now potentially forced countries to say, you know what, it's going to be more friction to do business with the U.S. Let's shrink the business, not like cut it all together. I don't think that happens. We're a huge consumer, but let's shrink the business and think about going more, domestic. And that's what I think this is. Like we're adopting more domestic policies and outlooks. Other countries can do the same thing. And honestly, if it's an us versus them, I don't like that. I mean, I know we're the US and that's supposed to be awesome, but us versus them, if everyone gangs up against us, like we're just the US, we're just one country. And we have a military, but what are we going to do? Fight everybody? So I don't know. This is a really interesting situation. I don't know how this looks like super rosy and super optimistic. And I don't like how the narrative is like the market's going to boom. Well, it's down 11 to 12%. It's down 15, 16%. Show me a boom. Like, what is it about right now fundamentally that the market's going to go up? I see very little evidence that the market can go up, and I don't see any real optimism that the market should go up. And that's why I don't think the bottoms are in. Okay. Real quick on the butterfly spread, we're right at that 5,400 strike. It's got to be trading closer to like $2 right now. This max profit, by the way, is up to $10. So yeah, I picked a good one. This is SPX. SPX right now trading for $2.30. My gosh, man. And if it stays like this for the next 10 minutes, it could potentially be a pin right at, I mean, that's a $1,000 pin if you got the guts to hang on to it, but I'd still be happy with, $2.25 and a 65-cent debit. Good trade. So I'm going to make a note in my double up tracker. I'm looking at this, comment. So it is 3:50 p.m. Eastern time, trading for $2 credit. So big fat win. And it'll continue to climb. Like right now, this is in the pin price. I just don't like taking this to the final minutes. If you want this thing to cash settle, the nice thing is if you are at 5401, that's a $900 bonus profit. If you're at 5402, that is an $800 bonus profit. If you're at 5395, that's a $500 bonus profit. But you won't know that until it settles in the last 10 minutes, which kind of sucks because this thing can move 3, 5, 10 points in a matter of minutes that maybe keep you pinned at 54, push you through the pin. But right now there it is. It's up to $3 right now. It's like, don't get greedy. This is a great trade. You're in the profit trap right now. It's fun, it's a nice win, but take the profit if you got it. Let's see here. Dean says, I was not able to get the daily profit late this morning, so the afternoon I entered bear call spread, was able to make $220. Dean, that's awesome, dude. Yeah, we went 3 for 3 today for daily profit play. We had our morning trade. I did an afternoon trade or late morning trade, and then I put in broke wing butterfly. So 3 for 3 on the day. Not bad. Okay. Earnings shouldn't be bad, but unless the tariffs that's what I'm saying is like it's the guidance, right? It's the forward guidance, the uncertainty, the pessimism. If that's baked into these earnings calls and the revisions are much lower, that hasn't been priced in the market yet. And that's where things do get pretty nasty, is if earnings are going to get worse, that's not baked into the market. Yep. And I agree with that, Lee. I don't think he's thought the whole thing through. I totally agree with that. I think there's a lot of news and headlines and swirling, and we've got a president that's on the economic calendar all the time. And I think this is like, is it like fire ready aim? I don't know. I mean, you want to think that the administration is trying to do its best, but there are global ramifications for basically declaring a trade war, right? Like this is the stuff that was talked about in 2016 that nobody really took seriously, and the market kind of shrugged it all off. But we did have a 2016 vol event where the market was down 20% and then recovered, and then 2017 was this eerily low volatility climb. 2018 vol event, 2019 up to all-time highs, melted into 2020, COVID crash. Like it wasn't an easy 4-year market with Trump in this first term. So why does anybody think it's going to be the greatest thing ever? And it's counterintuitive because you had people like Stanley Druckermiller say, "I've never seen a more pro-business administration in my whole career." That's pro-business, and that's the Trump bump was in November, right after the election. This is different, you know. So I just think there are ramifications and consequences to what we just decided to do, and basically it's not a negotiating play. This is a threat, right? When you come out with, yesterday's announcement, I just started taking screenshots in real time news. This was the announcement: tariffs, 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 tariffs. Right? You want to do business with the U.S. Tariffs, and I understand that the U.S. has been taken advantage of as far as our generosity and our wealth to basically have import tariffs, right? But now, if you do business in the U.S., we'll treat you fine. If you import to the U.S., we will tariff you. And so you have to wonder if these countries decide it's not worth the cost of doing business, and how much does that escalate? I don't know. But if the Eurozone turns its back on the U.S. in some way, shape, or form, if China turns its back on the U.S. in some way, shape, or form, there will be alliances that change, and it will leave the U.S. isolated in the corner somewhere. And we think we're great, but if nobody is supporting us except for ourselves, that's a very different economy, you know? And I don't know. And that's the thing, is not knowing is okay. But I'm certainly trying to make decisions to make sure if this market does something really silly and crazy, which it can. Look, a 20% correction is a normal thing. It happens every couple of years. A 20, 30, 40% correction is rare, but it does happen, and usually it's happening with some pretty bad stuff. This is one. This could be a landscape for some bad stuff happening, and I don't know yet. I mean, throw the seasonality stuff out the window. That's what's confusing about right now. You'd like to think the market has what it takes to get through earnings and be kind of unscathed, but if earnings all of a sudden looks, and I keep saying this, but if earnings looks rough, the market has not priced it in yet. So, I mean, anybody that's in my newsbreaker service, we're probably trading both directions on a lot of trades this next like 2, 3, 4 weeks because the market could be very volatile. And that's not a bad thing. Like it's good for volatility, it's good for individual trades. But the broader market, I want to make sure that I'm hedged, right? Okay. So again, this is not a political thing. This is just like on paper what I'm seeing, and I'm really interested what the thought is behind this process of basically declaring a trade war. It was always used as a term in 2016, 2017, but it never really came to fruition. This certainly has a little bit more of a serious tone to it. This feels like a lot of a threat. And all the while, you're seeing things rotate out of the U.S. anyway. What's one of the best performing assets this year? Gold. What's the best performing index this year? The DAX, the Euro stocks, China. It's not the U.S. There are countries that are doing way better than the U.S. right now as far as their performance. But that being said, the one card the U.S. does have is if we go deep enough to the downside, if the U.S. goes into a recession, 20, 25, 30, 35, 40% corrections, it's going to drag the entire global economy down. So if the U.S. is like, you know what, screw it, let's take everyone down with this. It can. We're big enough GDP. We're big enough globally, but it's going to be a nasty reset. You know. So anyway, it's a lot of stuff swirling. I'm still trading my way through it. I'm curious how this settles in the next couple of days. I mean, this is just a lot of implied volatility jumping from. I'm surprised SPX. This must have been a misprint on my platform today. But IV rank at 40. Very curious if tomorrow this is at like 45 or 50. The VIX has jumped up a little bit today, not a ton, but it jumped up a little bit. We're at 29.39, which is right back up to the highs that we had March 13th. Right, so we are very close to getting some fresh highs. Another way to look at this is go back to the bear market in 2022. We had several spikes on the volatility index from 30 to 40, 30 to 40, 30 to 40, and this was obviously a bear market. Right, this was a bear market. Patricia says Europe is the worst. You have no idea. Sure, but it doesn't mean they have to be our allies. I mean, that's the thing is like I get it that like the U.S. is not as bad as many other places, but if we're going to make allies frenemies and frenemies enemies, that doesn't look good. And the U.S. is big enough that if it goes down, it drags everybody with it. I fully believe that. So there might be little to nothing performing green this year if the U.S. doesn't have some type of stability. So I'm trading it too. I want to see resiliency. I want to see the market go back to all-time highs. I want to see this bull market somehow get back into place, but I don't see it technically anytime soon. I mean, what is it arbitrarily about a correction here that is down about 12%? Is there something magical about that number that's going to say, oh, going to all-time highs now? Not even close, right? This low, this low, this previous high. That's why I had the box right there. That's about the next spot. I'd say, technically speaking, this would be where the market could bottom. So how do we get there? All the different ways. We could have this movement here. We could go up again and then down again, up again, down again. We could fall in a straight line that scares everybody to death, and then a little pullback here that's faded down, and then another leg lower. And then we're waiting to see what the bottom formation looks like, and is it enough to get back the all-time highs? Is this a larger swing, right? Like I'm just sitting like all this stuff. Is this a larger swing to more downside? I have no idea because there's an outer trend line. You thought the 2022 correction was bad. What if we're sitting here at all-time highs with stocks that can't grow and inflation that's sticky and yields that are still rising? I mean, it could potentially be a really tough. I mean, do you remember talking about the lost decade? Right? It didn't happen. We've been climbing the wall of worry for years, but this lost decade of like, it could be years of building this thing back into, justifying all-time highs and valuations again. You know, so I'm just saying, like, don't take this market lightly. I think this is a real test for everyone that's never really experienced a nasty correction. A one and done correction like July to August that was immediately bought on the dip. Well, that was in the wake with a lot of positive fundamentals. This is a big shift. fundamentally, I don't see a lot. I don't see a lot of good. So that makes me very skeptical. And I think for right now, I'm better having hedges. I'm better trading the market bearish and fading, and until I'm proven otherwise. So closing bell damage is done. 53.94. That is a $500 trap on the old SPX. Look at that baby. Ooh, baby. At close, $5.85. Crazy, man. At close trading for 5.85. That's almost 1,000% winner. 585 minus 65. That's an 800% winner in that butterfly. Good Lord. Special stuff right there. Cool. No, I can't look at currencies. I got to go. I've got a session at 4 p.m. My crash insurance masterclass is starting. I'm excited to get into that. This has been pretty much perfectly timed. Not that I intended it this way. I was hedged before the year even started. Had some nice payouts on those hedges. This allowed me to stay positive for the year so far, barely. This is obviously a pretty nasty day. I'm down 140K today. Now, a lot of it's unrealized option prices, and the volatility swell is causing some pain. But I still have plenty of cash. I'm deploying a little bit of capital. I'm watching. I'm waiting, but I'm hedged. So, I mean, the hedges will potentially take a little bit more time to play out. We'll see how nasty things get, but that'll help offset this, and then we'll get closer to expiration. Tomorrow's a new day. So, all right, if you're in my Crash Insurance Masterclass, let's jump into that Zoom session, and I will see you soon. Guillermo, come to my session tomorrow. We'll look at currencies tomorrow. I do them typically multiple times a day. So, currency strength wise before I go, there was a lot of volatility today. Swiss was strongest, dollar was weakest with a lot of volatility. So dollar Swiss straight down today, almost 360 pips from high to low. That's a big smash, but we'll see if it gets down to the lows at like 85 or 84, and then maybe bounces up and has some efficiency. So all right, Crash Insurance Masterclass. I'll see you in a few minutes. Thanks, bye.